Hey, you. Ever been curious about what happens if you just let your Nifty or stock futures contracts run all the way to expiry?
Uh-huh.
It's a question that probably crosses every trader's mind, right?
Yeah.
Especially when you're trying to, sharpen your edge in the market.
Yeah, definitely.
So today, we're diving deep to bring some clarity to exactly that.
That's right. We're focusing on what occurs when you don't square off those nifty futures and stock futures positions. We've got some really insightful material here that breaks down the nitty-gritty.
Especially for beginners, I guess.
Exactly. Particularly if you're navigating the futures landscape for the first time. Our goal is just to make sure you understand the implications so you can, well, trade with greater confidence.
Okay, let's unpack this then. Starting with Nifty futures. Now, the first thing that's really key to remember is that Nifty futures are cash settled.
Right. Cash settled.
They're based on the Nifty 50 index, the benchmark for the Indian stock market. And these contracts, they expire monthly, last Thursday. That cash settlement part, no actual shares changing hands. That's the foundation here, isn't it?
Precisely. It really just boils down to the price difference at expiry. So imagine you bought a Nifty futures contract, and as expiry comes around, you find yourself maybe, let's say, 10,000 in profit,
Okay.
and you haven't closed your position. What's the automatic process?
Well, the exchange, the NSE, they'll automatically settle your position. It's based on where the Nifty 50 index actually closes on that last Thursday.
Okay.
So say you bought one lot of Nifty futures, that's 75 units, right?
Yep, 75 units.
Bought it at 25,000, let's say. If the Nifty closes at 25,133.33, well, that's a profit of 133.33 per unit.
Okay, makes sense.
Multiply that by 75 units, and there's your 10,000 gain.
But it's not quite as simple as just seeing that 10 grand pop up in your account balance, is it? There are costs involved.
Well, absolutely. Always costs.
Yeah.
Understanding these is crucial because they eat into your profit.
Right.
You'll have brokerage charges. Let's factor in maybe 40 for the round trip.
Right.
Buy and sell effectively.
Mm.
Then there's the big one, Security Transaction Tax,
Yeah.
STT. For Nifty futures, it's currently 0.01% of the contract value, but only on the sell side.
Okay, so on the expiry settlement in this case.
Exactly. So at an expiry value around, say, 18,085,000, that STT would be roughly 188.50.
Okay.
Plus, you need to factor in other smaller exchange-related fees, maybe around 100 or so.
So if we tally that up, you've got the 10,000 profit minus 40 brokerage minus about 188.50 for STT minus another euro with it. You're left with a net profit closer to what, 9,671.50.
Yeah, around that mark. And this usually gets credited to your trading account the next trading day, so T+1.
Right. And crucially, no shares involved at all, purely cash.
Pure cash. Now, what if the market moved against you? Flip side. Say you hadn't squared off and were facing a 10,000 loss on that Nifty futures position at expiry. How does that automatic settlement work then?
Well, the automatic cash settlement still kicks in, same process, but this time your account is going to be debited.
Makes sense.
Using our earlier example, if you bought that same lot at 25,000 and the Nifty closes lower, say over 24,866.67, that's that 10,000 loss we're talking about.
And just like with the profit scenario, those pesky charges don't just vanish, do they? They'll make the final hit a bit bigger.
They certainly do. You'll still have the brokerage, that 40. The STT, calculated on the lower contract value now, around 18,065,000. So that'd be approximately over 186.50.
Okay.
And those other charges, maybe 100, they still apply. So your total outflow isn't just the 10,000 loss itself.
Right. So the actual debit from your account would be somewhere in the vicinity of 10,326.50.
Yeah.
And this is a really critical point, isn't it? If your trading account doesn't have enough funds to cover this debit.
Exactly. That's where things can get tricky. Your broker will likely take action. They might have to liquidate other securities in your portfolio to cover that shortfall. Yeah. And if that's still not enough, they could even levy penalty charges. This really just highlights why understanding the potential downside and, crucially, having sufficient capital is, well, non-negotiable when you're trading futures.
So the key takeaway with Nifty futures seems to be this automatic cash settlement at expiry. It's convenient, sure, but you absolutely have to factor in the charges. They reduce profit, increase loss, and make sure you have the funds if things go south.
Couldn't agree more.
Now, let's quickly consider the other side. What if you had sold Nifty futures initially, shorted the index, and didn't square off?
The core principle, cash settlement, it stays exactly the same. If you started by selling, you make a profit when the index price moves lower, below your entry.
Right.
So if you sold one lot at 25,000 euro and it expires down at 24,866.67, you still realize that 10,000 profit.
And the charges in this case,
Mhm.
would they be pretty much the same as when you bought and made a profit? A mirror image.
Yeah, the structure of the charge is very similar. You'll have the brokerage, the STT, again, it's applied on the sell leg of the expiry settlement. But since you initially sold, expiry is like a buyback for you, so it still applies.
Oh, okay. Got it.
And those minor exchange fees. So consequently, your net profit in this scenario would likely be around 9,673.50, very close to the buying profit scenario.
Okay, that makes sense. Now, for the scenario nobody really wants.
Yeah.
You sold Nifty futures, didn't close out, and boom, you ended up facing a 10,000 loss at expiry. Price went up instead of down.
Yeah, in this situation, the index would have moved upwards, gone past your initial selling price. So if you sold at 25,000 and it expired up at 25,133.33, that results in that 10,000 loss.
And just like before, the charges get tacked on to that loss.
Exactly. Brokerage, STT, other fees, they all add up. So the total debit from your account would be somewhere in the ballpark of 10,328.50. Again, very similar to when you bought and incurred a loss.
But there's something particularly crucial to keep in mind when you're selling futures, isn't there? It's about the risk profile.
Indeed. Very important point. While the settlement is still just cash, the risk dynamic of selling or shorting is fundamentally different. Your potential losses are theoretically uncapped.
Right, because the index could just keep going up and up.
Exactly. If the index were to experience a massive unexpected upward surge, your losses could technically keep mounting. So even though the immediate settlement is just a cash adjustment, the inherent risk exposure when shorting demands really careful risk management.
Okay, so cash settlement for Nifty, buy or sell, profit or loss. Got it. Now, let's pivot. Let's shift gears and dive into stock futures, because you mentioned things operate a bit differently there.
Yes, this is a really, really important distinction. Unlike Nifty futures, stock futures, the ones based on individual company stocks, they have been subject to physical settlement in India since October 2019.
Physical settlement.
That term physical settlement is absolutely key here. It means that at expiry, if you haven't squared off, it's not just a cash adjustment. It involves the actual transfer or receipt of the underlying shares.
Okay, well, so actual shares moving around. Let's break that down. Say you bought stock futures, maybe one lot, 500 shares of company X, and you're looking at a 10,000 profit as expiry hits, and you haven't closed out. What happens then?
Right. In this scenario, because it's physical settlement, you will actually receive those 500 shares directly into your DMAT account.
My DMAT account.
Okay, yes. But, and this is crucial, you will also be obligated to pay the full contract value based on the settlement price. That's usually the closing price of that specific stock on expiry day.
So I get the shares, but I have to pay for them, even with a profit.
Yes. Your 10,000 profit effectively just reduces the net cash outflow you have to make.
Okay, can we walk through an example? Numbers usually help.
Certainly. Let's assume you bought 500 shares of a stock via futures at 1,000 per share. That's a contract value of 500,000 initially.
Got it.
If at expiry the stock closes higher, say at 1,020, your profit is 20 per share times 500 shares, that's your 10,000. Now, you will receive those 500 shares in your DMAT account. And you'll be required to pay 1,020 per share for them, which amounts to 510,000.
Wow, okay. 510,000.
But remember, your 10,000 profit, that gets factored in. So the net amount actually debited from your trading account will be 500,000 plus, of course, the charges.
Ah, the charges again. And you mentioned they're structured a bit differently for stock futures. Higher, maybe?
That's right. They do tend to be higher, mainly because of the logistics of actually moving shares around, the physical delivery aspect.
Makes sense.
You'll still have your brokerage. Let's stick with 40. But the STT for physically settled stock futures is much higher. It's more 0.1% on the sell side.
0.1%. Okay, that's 10 times the Nifty rate.
Exactly. So with a contract value at expiry of 510,000, the STT alone would be around 510. Then you'll likely encounter specific delivery charges, maybe around 100, and other miscellaneous fees, maybe another euro. This higher cost structure is a key reason many traders prefer to just square off stock futures before expiry unless they specifically want the shares.
Right, so if we add those charges of 40 brokerage, 510 STT, maybe 200 in delivery and other fees, that's closer to 750 in total charges.
Roughly, yes.
So that 10,000 profit gets trimmed down to about 9,250, and you've also ended up with 500 shares in your demat, having paid out a net amount of around 500,750.
Precisely. And this really underscores a critical point. For stock futures, if you're the buyer at expiry, having both a functional demat account and sufficient funds to cover the entire contract value is absolutely essential, even if your position is showing a profit on paper.
Got it. Demat account and the full cash amount ready. Okay, now what if you bought those stock futures, didn't square off, but instead were facing a loss?
Yeah.
Say that 10,000 loss again. How does physical delivery work then? Do you still get the shares?
Yes, you do. Even when you're facing a loss, the physical delivery is still mandatory. You will still receive the shares into your demat account.
Even if I don't want them anymore because the price dropped?
Even then. And you remain obligated to pay the contract value, but this time it's based on the lower settlement price. The loss is simply the difference between your initial futures purchase price and the lower value at which the contract is ultimately settled.
So same numbers, bought 80 or 1,000, a 10,000 loss means expiry at 980. You still get the 500 shares delivered into your demat. How much cash actually changes hands then, and what's the final net loss considering charges?
Okay, so you would pay $980,000 per share, totaling $490,000 for the 500 shares.
Right.
The STT would be based on this lower value, so 0.1% of $490,000 is $490.
Yeah.
Add the brokerage, 40, and other charges, say $200. Your total fees would be approximately $730.
Okay.
Therefore, your initial $10,000 paper loss actually expands to a real loss of roughly $800,730, and you've paid out a total of $490,730 to receive those 500 shares you might not even want anymore.
Wow. Okay. So buying stock futures and not squaring off always means getting the shares.
Yeah.
And you absolutely must have the funds ready, profit or loss. Crystal clear. Now, let's tackle the seller's side for stock futures. What if you sold them and didn't close out before expiry?
Right. So when you sell stock futures, you are essentially making a commitment, an obligation to deliver those specific shares at expiry.
To deliver them from my account.
Exactly, from your demat account. So if you don't square off your short position, and let's say you find yourself with a $10,000 profit because the price went down as you expected.
Good scenario profit.
Good scenario, yes, but you are still obligated to deliver those shares from your demat account at that lower settlement price.
Right. Okay. So if I initially sold 500 shares via futures at 1,000 and the price falls to 988 by expiry, giving me that 10,000 profit share, I still have the responsibility to physically provide those 500 shares.
You do. You need to have them in your demat account ready for delivery.
Okay. What's the final financial outcome then? I deliver the shares. What do I get?
You would deliver the 500 shares. In return, you would receive the contract value based on the settlement price, which is $980,000 per share, totaling $490,000.
Okay.
Your profit comes from the difference between your initial higher selling price and this lower settlement price. After accounting for the brokerage and the STT on the delivery, but 0.1% of $490K, so about $490K, plus other minor charges, say $200, your net profit would be somewhere in the region of $9,270.
So even with a profit, the absolute prerequisite was having those shares in my demat account before expiry to make the delivery.
Absolutely crucial. Now, what happens in the less desirable situation? You sold stock futures, didn't square off, and ended up with a $10,000 loss because the price went up instead of down. Yes, this is where the potential for serious complications really escalates. If you sold, anticipating a price decrease, but instead the price rose, say, from your sell price of $1,000 to $1,020 at expiry, resulting in that $10,000 loss, you are still legally bound to deliver those 500 shares.
Deliver them at the higher price.
You deliver them, and the settlement happens at the higher price of $1,020. But the real question is, what if you don't actually have those specific 500 shares in your DIMIT account at the time of expiry? What then? That is what's known as a short delivery, and it can trigger significant financial penalties. It's a big problem.
Short delivery. Sounds bad. What happens?
It is bad. Your broker will likely try to buy those shares for you in the open market, maybe even at a price higher than the official settlement price, just to fulfill the obligation, and you'd be responsible for that cost difference.
Okay.
Worse still, the exchange itself might step in and conduct an auction specifically to acquire those missing shares. You would then be liable for any difference between the auction price and the settlement price, plus additional penalty charges levied by the exchange.
Wow. So the penalties could be substantial.
Very substantial. This risk of short delivery and the associated costs and penalties is an absolutely critical consideration when selling stock futures. You must avoid it.
So in our 10,000 loss example, sold at 1K, expires at 1,020, you're obligated to deliver 500 shares. If you don't have them, you might end up having to buy them in the market at 1,020, or potentially even higher in an auction, costing you 510,000 or more. You'd receive the settlement amount based on 1,020, but you've already likely paid that or more just to get the shares.
Exactly. And then the charges still apply on top of that loss.
Right, so the STT on the delivery value, around 510K, would be about 510. Add brokerage and other fees, your initial 10K loss becomes maybe 10,750, plus any extra costs from the short delivery auction or penalties.
Precisely. The financial hit from short delivery penalties can be very painful. It's a situation you really, really want to avoid at all costs.
Okay, so the major takeaway here is that with stock futures, physical settlement is absolutely not optional. If you're buying and don't square off, expect to receive shares, you need the cash, you need the demand account. If you're selling and don't square off, you absolutely must have those shares sitting in your demand account ready to go to prevent potentially severe financial consequences from short delivery.
Couldn't have put it better myself. And this understanding, this whole discussion, it leads us directly to some really crucial pieces of advice, doesn't it? Especially for those who are maybe relatively new to trading futures.
Okay, let's hear it. What are the absolute must-knows, the key advice for a novice trader trying to navigate futures expiry?
Okay, rule number 1, the big one. Square off your positions before expiry. Seriously.
Just close the trade.
Just close it. This is the most straightforward way to sidestep all the complexities of physical delivery and stock futures, and also avoid the potential price volatility that often happens as expiry gets really close for both Nifty and stock futures. Aim to close your trades, well before the market closes on expiry day, maybe by early afternoon, just to be safe.
That sounds like solid, practical advice. A golden rule, maybe. What else should traders keep top of mind?
Well, it's vital, absolutely vital, to clearly understand that fundamental difference between cash settlement for Nifty futures and physical settlement for stock futures.
Cash versus physical.
Exactly. Nifty's cash settlement is generally simpler, easier to grasp for beginners. Stock futures, though, they introduce that whole extra layer of responsibility for a share delivery or receipt and the need for that demat account.
Right. And you mentioned leverage earlier. Futures are leveraged instruments. How does that play into expiry?
Oh, hugely. Closely monitor your margin levels, always. Futures trading involves leverage, meaning you're controlling a large contract value with a smaller amount of capital, your margin.
Right.
You need to ensure you maintain sufficient margin in your account at all times, but especially as expiry nears, to cushion against any sudden adverse price moves. A margin call near expiry is not fun.
No, definitely not. Managing risk seems key.
Yeah.
Any other practical steps?
Yeah, a few more. Always check the specific fee structure of your broker. Find out exactly what they charge, particularly for things like auto square off if you don't close the position yourself, or any fees related to handling the physical delivery process for stock futures.
Broker fees can vary, right?
They can. Some might have extra charges. And, to reiterate, if you're a buyer of stock futures and you do intend to let it expire and take delivery double triple check, you have adequate funds for the full contract value and a functional demat account.
Okay. And for sellers?
And conversely, if you're selling stock futures, make absolutely positively sure you have the required shares physically present in your demat account well in advance of the expiry date. Avoid those huge short delivery penalties. It's critical.
What about the general risks of selling or shorting futures?
Yes, always be acutely aware of the potentially unlimited risk associated with short selling. That applies whether it's Nifty or individual stock futures.
Unlimited loss potential.
Right. The potential for losses isn't capped if the price moves strongly against your short position. Using risk management tools like stop-loss orders is absolutely crucial in those scenarios, especially around the volatile expiry period.
Okay. Are there any tools or maybe strategies you'd suggest traders use?
Definitely. Make use of a trading calculator. Most brokers offer them, or you can find them online. Use it to estimate your net profit or loss after factoring in all the charges, brokerage, STT, exchange fees, any potential delivery fees. It gives you a much clearer picture.
Instead of just looking at the gross profit loss.
Exactly. Get the real picture. And finally, just always remember that expiry days themselves can be quite volatile. Prices can swing significantly. If you're uncertain about the settlement process or unsure about the market direction, it's generally just prudent to avoid holding your positions too close to that expiry deadline. Better safe than sorry.
Okay, so bring it all together then. while the exchange will automatically handle the settlement of your futures positions at expiry if you don't do anything. A really thorough understanding of those fundamental differences, cash for Nifty, physical for stocks, is absolutely essential. You really have to be aware of all the charges, ensure you have the capital or the shares ready,
Oh.
basically manage your obligations.
Yeah.
Ignoring these details, it sounds like it can lead to some really unexpected and potentially quite costly outcomes.
Exactly. It's really about going beyond just thinking about the potential profits. You need a solid grasp of the mechanics, the plumbing of how it works, and the various potential consequences at expiry. That deeper understanding is just paramount for effective risk management and ultimately for navigating the futures market with more confidence and control.
That makes a lot of sense. So, thinking about all this, considering those complexities, especially around physical settlement and stock futures, I wonder what sort of proactive strategies might more experienced traders use during expiry week to manage their positions effectively.
That's a good question for further thought.
And maybe for the novice trader who's grappling with the leverage involved in all futures trading, what are some really core principles for diligently managing the risks that come with maybe not squaring off those positions? Some important things to ponder, maybe, as you continue to explore this dynamic world of trading.
Definitely food for thought.
Well, thanks for taking this really insightful deep dive with us today. We trust it's provided you with some valuable clarity on what happens when futures meet expiry.